ever wondered how global conflicts can affect your investment portfolio? Well, it's time to find out. Today, we're exploring a very topical issue that's making waves in the financial world and beyond, the ongoing conflict between Russia and Ukraine. This isn't just a regional issue, it's a global one. When nations clash, it's not just their economies that feel the pinch. The ripples are felt worldwide, affecting stock markets and economies on a grand scale. In this context, the impact of the Russia-Ukraine conflict reaches far beyond their borders, influencing the global stock market and economy. This situation underscores a critical truth. In our interconnected world, no economy is an island. So, what does this mean for you, the investor? Well, it's crucial to understand that geopolitical events can significantly influence the performance of your investment portfolio. So, let's delve into the 10 ways this conflict can affect your investments. First off, let's talk about trade disruptions. When conflicts arise between nations, it's like a stone thrown into a calm pond. The ripples spread out, affecting more than just the immediate area. Similarly, the tensions between countries can disrupt trade routes and agreements. This leads to a domino effect of uncertainty about the flow of goods and services. And as we all know, the stock market doesn't respond well to uncertainty. Investors react, prices fluctuate, and the landscape changes. Now, in the face of such turbulence, where do investors turn? Well, they usually seek out what we call safe haven investments. These are assets that are perceived to hold their value or even grow during times of market turmoil. Think of gold, government bonds, and yes, even cryptocurrencies. These assets often see increased demand during conflicts, leading to higher prices. But the ripple effect doesn't stop there. Conflicts like the one we're seeing between Russia and Ukraine can cause global shifts in energy prices. For instance, Russia is a major exporter of natural gas. Any disruption to its supply can send energy prices soaring worldwide. Industries like transportation and manufacturing, which rely heavily on fuel, can see their costs go up. This, in turn, can affect their stock prices. And let's not forget about the defense industry. In times of conflict, governments may increase their military spending. Companies that manufacture weapons, technology, and other defense equipment can experience a surge in their stock prices. On the flip side, conflicts can also lead to fluctuations in currency values. Investors, always assessing the economic stability of countries, may see their trade and investment strategies influenced by these changes. As you can see, conflicts can greatly influence trade and investment trends. They can shake up the status quo and create new winners and losers in the global economy. The ripple effects are far-reaching, affecting everything from the price of your morning coffee to the return on your investment portfolio. Now, let's discuss how conflicts can affect energy prices and the defense industry. As we know, Russia plays a significant role in the global energy market. It is one of the world's top natural gas exporters, and a large portion of this gas powers Europe. When conflicts arise, they can disrupt these vital energy supplies. So, what happens when the gas stops flowing or the flow is reduced? Quite simply, energy prices can skyrocket. This has ripple effects on various industries, particularly those that rely heavily on fuel. Think about transportation, manufacturing, and power generation companies. As their operating costs go up, their profits can take a hit, and this can be reflected in their stock prices. But it's not all doom and gloom. In times of conflict, some sectors can actually experience a boost. One such sector is the defense industry. As tensions rise, so does the demand for defense equipment and technology. Governments may increase their military budgets to ensure they are prepared for any potential escalation. This can lead to increased orders for defense companies, boosting their revenues and, subsequently, their stock prices. However, it's important to remember that this isn't a sure thing. Increased defense spending can put a strain on a country's finances, leading to potential budget deficits and economic instability. And, as we've discussed earlier, economic instability can lead to stock market volatility. So while defense stocks may see short-term gains, the long-term outlook could be more uncertain. In the midst of conflict, we also see a shift in investor behavior. Some investors may divest from sectors they perceive as risky, such as energy, and move their funds into what they consider safer industries, like defense. This reallocation of capital can further impact stock prices across various sectors, adding another layer of complexity to the situation. Clearly, energy and defense sectors are heavily influenced by global conflicts. As we navigate through these turbulent times, it's crucial to stay informed and understand how these dynamics can impact our investments. Moving on, we must consider the impact of conflicts on currency values and consumer confidence. In the global economy, conflicts can stir up waves that reach far beyond the immediate battlefield. One of these waves is currency fluctuation. As tensions rise, investors start assessing the economic stability of the countries involved. This can lead to shifts in currency values. For instance, if a country involved in a conflict is seen as economically unstable, its currency may depreciate. This depreciation can then impact international trade. If a country's currency is weak, it becomes more expensive for them to import goods, but their exports become cheaper for others. This imbalance can lead to trade deficits or surpluses, affecting the overall economic health of the involved nations. Now, these currency fluctuations don't just exist in a vacuum. They ripple out, influencing stock market movements as investors adjust their strategies based on these changing currency values. For example, if a company does a significant amount of business in a country whose currency has depreciated, it could see a reduction in its revenue and profitability, leading to a potential drop in its stock price. But the effects of conflict are not limited to the financial markets. They also seep into the psyche of the everyday consumer, affecting consumer confidence. In times of conflict, people often become uncertain about the future. They may worry about job security, inflation, or economic stability. This anxiety can cause a decrease in consumer spending. When consumers tighten their purse strings, businesses feel the pinch. Reduced consumer spending can lead to lower revenues for businesses, which can, in turn, affect their stock prices. This is why consumer confidence is such a critical barometer for the economy. It's like a canary in the coal mine, offering early signals of potential economic downturns. So, conflicts can deeply impact currencies and consumer confidence, affecting the stock market. They can create ripples that move through currencies, stock markets, businesses, and ultimately individual consumers. It's a stark reminder of how interconnected we all are in this global economy. Let's now look at how conflicts can disrupt travel and global supply chains. When nations clash, the ripple effects can extend far beyond their borders. One of the industries that can take a significant hit is international travel and tourism. Imagine a scenario where flights are grounded, airports are closed, and once bustling tourist spots become ghost towns. This can be a stark reality in times of conflict. Airlines, hotels, and leisure companies can find their revenues plummeting in such situations. With fewer people willing or able to travel, these industries can face a serious downturn, and you guessed it, this can lead to a drop in their stock prices. An investor keeping an eye on these sectors would do well to monitor global events and anticipate such disruptions. But the impacts of conflict don't stop at travel. Global supply chains can also be affected, and the results can be far-reaching. Let's consider a hypothetical situation where trade routes are blocked due to a conflict. Goods and raw materials can't get to where they're needed, causing delays in production. For companies that rely on these materials, this can spell trouble. When production schedules are thrown off track, it can lead to missed deadlines, unsatisfied customers, and ultimately a hit to the bottom line. This in turn can cause stock prices to tumble. An investor tracking companies dependent on global supply chains would be wise to consider the potential impacts of geopolitical conflicts. From travel to supply chains, conflicts can truly have a wide-reaching impact. They serve as a stark reminder of how interconnected our world is, and how global events can influence industries and markets in unexpected ways. As investors, keeping a finger on the pulse of world events can help us navigate these turbulent waters and make informed decisions. From the bustling airport terminals to the quiet assembly lines, the impacts of conflict are felt far and wide. Last but not least, let's talk about geopolitical tensions. The conflict between Russia and Ukraine isn't just a two-country issue. It's a global concern, capable of ratcheting up tensions far beyond their borders. And what happens when tensions rise? You guessed it. We see increased volatility in the stock market. Investors, always sensitive to the winds of change, react to these shifting dynamics, and their responses can cause the market to swing wildly. Let's take a quick recap. This conflict affects trade and investments, can disrupt energy and defense industries, leads to currency fluctuations, and impacts consumer confidence. It can also cause travel disruptions and supply chain issues. In essence, the ripple effects of any geopolitical conflict can be far-reaching, influencing the global economy and by extension your investments. Thanks for joining us today. Remember, knowledge is power when it comes to managing your investments. Don't forget to like, share, and subscribe for more insightful content.